Interest rates are up 600% in 13 weeks and people are freaking out. So what now? The Bank of Canada announced June 1st that the overnight rate will be up 0.5% or 50 basis points to 1.5%. This is the third consecutive raise, its second consecutive of 50 basis points. What is their outlook? They continue to judge that interest rates will need to rise much further to fend off galloping inflation. And they're prepared to act more forcefully if needed to meet its commitment to achieve the 2% inflation target. The next scheduled date for announcing the overnight rate target is July 13th. Economists are forecasting another 0.5% raise. Banks follow the Bank of Canada with a hike in their prime rate pretty much immediately, which impacts us. How does it affect us? My friends also call me Mr. Positivity, so I can't do this video without mentioning some of the positives of higher rates. The Bank of Canada raising the overnight rate and quantitative tightening is one of the tools in their toolbox they can use to stomp down that sky-high inflation. Some sectors of the economy flourish with higher rates. Banks and insurance generally do well, if the economy continues to tick, of course. GICs, high-interest savings accounts, and fixed-rate investments will all benefit from higher rates. However, here's the flip side. Those increases do not outweigh the power of inflation right now, which is at a 31-year high, 6.8%. The 0.5% increase increases lending costs for everyone with a variable rate mortgage, line of credit, and loans. This usually negatively impacts housing prices. Purchasing power decreases as the cost of borrowing increases. With this 0.5% increase in prime, variable rates are now hovering between 3.1 and 3.9%, depending on the lender. Here's a basic example of how this could impact homeowners and potential buyers. Look at this typical affordable Vancouver home priced at $1.5 million. Let's presume we take a $1.2 million mortgage on this bad boy and say we got a good variable rate of 2.7% June 1st. What are the implications of higher rates? Our payments may be unaffected if we have a cap rate protection, meaning same payment, only a higher portion will go to interest. This will result in a higher balance owing at the end of the term and potentially higher payments when you renew. Or with an adjustable payment plan, our payments will go from $5,496 to $5,803, a $307 difference literally overnight. But there's more. Equity is building slower as we see here. More of the payment is going towards purely interest, $28,313 more. And yet, we would have an ending balance that is $9,896 more. Yuck! And we can see how the next rate raise in July would just make matters worse. This extra financial cost generally causes home values to drop, which we have started to see across the country. There are also longer-term consequences with increased overnight rates. It could delay retirement for some, longer debt repayment, less investment, less cash for non-essentials, higher possibility for stagflation, higher possibility of a policy-induced recession. So what can we do? The reality can get ugly, but we can make the best of it. The Bank of Canada said rates are going up. So we can take the time now to look at our budget, see where we can get rid of some non-essentials. We can re-examine how much we invest and try to pay down some of our high-interest debt, which hopefully doesn't exist. If we have a variable rate mortgage, we can consider locking into a fixed rate mortgage for the peace of mind of knowing our monthly payment. So to wrap it up, what can we say? Rates will go up and down like a roller coaster as they always have. We'll eventually hit a recession as the economic cycle continues. The 15 years since the financial crisis were an economic boom. What do the next 15 years look like? It's anyone's guess at best. The past 2 years taught us all that. There's no magic answer to higher rates. What we can do is stay fiscally disciplined, continue to invest safely when we can, and try our best to keep our debt down as always. Thank you so much for watching. If you like this video, please help the like and subscribe button enter hyperinflation. Until next time, I'm Mr. Financial.